What if I told you that 2026 is setting up for a jagged ride, a potential stock market correction of up to 20%? The charts and the macro data are flashing warning signs, but here is the secret. The smart money is not selling, they are waiting. Top analysts believe this specific crash will be the single greatest buying opportunity of the next decade. Welcome back to Success Blueprint. Today we are decoding the 2026 market strategy. We are breaking down exactly why the volatility is coming, the contrarian sectors you need to watch, and the data behind a massive $250,000 price target for Bitcoin. Let's dive into the blueprint. First up, why a 10-20% pullback is on the table in 2026. Then we pivot to where the smart money is rotating. And finally, the crypto path with the highest risk-reward, including the 250K case for Bitcoin. First, let's look at the bear case. Why is everyone expecting turbulence this year? The data points to a likely drawdown of 10% to 20% mid-year. There are three specific triggers you need to watch. The Fed transition. We are looking at a potential change in Federal Reserve leadership. The market hates uncertainty, and it always tests a new Fed regime. A single hint of a pivot can ripple across rates, credit, and risk assets. Washington picking winners. The government is becoming more deliberate about which industries get funding and which do not. This creates sudden winners and losers. The AI reality check. After a massive run, the market needs to pause and ask, are these AI valuations sustainable? When expectations outrun earnings, the market recalibrates. But here is the success blueprint takeaway. History shows that trying to time these drops makes you the enemy of your own portfolio. The strategy is not to sell everything. It is to treat this dip as a clearance sale. Volatility is normal and it clusters. Plan for it, do not fear it. Policy shifts, valuation, resets, and macro data shocks can reprice markets quickly. Preparation beats prediction, and preparation turns fear into opportunity. So, when that dip happens, what are you buying? For the last few years, the Mag 7 tech stocks were the only game in town. They are still strong, but they might not be the best trade for 2026. The smart money is rotating into energy and basic materials. These sectors have underperformed for 5 years. They are cheap, and they are due for a massive mean reversion. Think about the fundamentals. AI needs data centers. Data centers need massive amounts of power. That means energy. And as the global economy stabilizes, we need copper and raw materials. This is the contrarian trade of the year. Real cash flows, tangible assets, and better valuations. Financials can also benefit from a stubbornly higher rate backdrop. Rotation is not abandoning growth. It is adapting to a changing cycle. Diversify your drivers. Pair innovation with infrastructure. Build resilience now, so you are positioned to play offense when the market gives you a discount. Now let's talk about gold. Gold has been rallying, but there is a hidden driver that most retail investors are missing. It is not just central banks buying anymore. Market data suggests that major stablecoin issuers are becoming some of the largest private buyers of gold in the world. They are using their massive profits to hoard gold as a reserve asset. Combine that with the fact that gold is underowned. Most average investors have 0% gold in their portfolio. If portfolios shift even slightly to the recommended 5 to 10%, the demand shock could be huge. Gold is not a relic. It is a hedge that wakes up when risk rises. It has no counterparty risk and global recognition. You do not need a huge allocation, just enough to matter when it matters. In a world of policy shifts and leverage, gold can be the quiet insurance in a storm. And finally, the asset with the jagged path but the highest potential reward, crypto. Current market models are projecting a Bitcoin price target of $250,000 for this year. If Bitcoin makes a new all-time high, it proves that the deleveraging washouts of the past are finally over. But do not sleep on Ethereum. While Bitcoin is digital gold, Ethereum is the infrastructure. Wall Street is looking to tokenize real-world assets, credit funds, money markets, and they are building that on Ethereum. If the bull case plays out and Bitcoin hits 250K, Models suggest Ethereum could rally all the way to $12,000. But remember, this path is volatile. Drops of 50% are a feature, not a bug. Size your allocation so you can sleep at night. Small but meaningful if the thesis plays out. Risks remain regulation, liquidity, and macro shocks. For long-term, high-risk tolerance investors, a small allocation to both BTC and ETH can diversify a portfolio. They are not a replacement for stocks and bonds. They are a supplement. Proceed with clear eyes and a plan, not FOMO. So here is your success blueprint for 2026. Expect turbulence. Do not panic when the market drops 15 to 20% mid-year. Buy the dip. Have cash ready to buy high-quality assets when others are selling. Rotate sectors. Look at energy, basic materials, and financials. Do not just blindly buy tech, hard assets. Consider exposure to gold and Bitcoin as institutional adoption grows. Investing is about the long term. Do not let a jagged 2026 scare you out of a 10-year bull market. What is your play for 2026? Are you pivoting to energy stocks or holding your tech? Let me know in the comments below. If you want to build your wealth, make sure to smash that like button and subscribe to Success Blueprint. I will see you in the next video. Please remember, the content in this video is for informational and entertainment purposes only. This is not investment advice. The ideas presented here are based on theories and opinions about market trends. All investing involves risk. Please do your own research or consult a certified financial advisor before making any financial decisions.